Ever wondered how decoding financial statements could be a game changer for your business? Whether you are looking to acquire a new business, analyzing your own business, or navigating the world of tax strategies, learning to read these financial documents is a must-have skill. And in this video, we are going to dive deep into the nuts and bolts of these financial documents, aka the income statement, balance sheet, and cash flow statement. So, get ready to uncover the secrets that will not only help you demystify these documents, but also empower you to make strategic and informed decisions for success of your business. Hey there, it's Ruhi. As a seasoned commercial banker, I have had the privilege of guiding countless businesses through the intricate world of finance. Whether it's securing financing, optimizing cash flow, or crafting strategies to manage interest rate or foreign exchange risks, I've been there every step of the way. Now on this channel, I'm excited to share my insights with a larger community of businesses. So join me as we explore the secrets of financial success, learn together, and contribute to the growth and success of businesses one video at a time. So let's try to understand what is an income statement. Think of it as a report card for your business's financial performance. Income statement has two main components. One is revenues, which is the source of money that's coming in through the sale of your products or services. And number two is the expenses. This is the costs or the money that's going out. It could be your rents, it could be utilities, it could be costs for your employees, it could be taxes. So those are all the sources that lead to the money going out of the business. So revenue is money coming in, expenses are money going out of the business, and when you subtract expenses from the revenues, what you get is a net profit. So you want the net profit to go up, revenues to go up, but expenses to go down. And that's the brief summary of income statement, and today we are going to look at an example to better understand these components of income statement. So let's say you are in the business of baking cakes. So the source of revenue for your business is selling those cakes. Let's say one cake sells for $50 and assume that you sell 1,000 cakes each month. So every month your business is bringing in 50 times 1,000 worth of revenue. That is 50,000 worth of revenues. Now, do you get to keep all the 50,000 in your pocket? No, right? Because there are expenses that you incurred. Those expenses first is raw material. You needed the flour, you needed sugar, or like any flavors, chocolate flavor or any other flavor that you use to bake that cake. So those are the costs of raw materials. So you subtract those raw material costs from your revenues. When you subtract raw material costs from the revenues, what you get is a gross profit. So gross profit is the profit without any other fixed cost. You want your gross profit margin to be up. And then as you move further down the income statement, you will notice that some fixed costs will start to come in. One most important cost is cost of employees or cost of salaries. So then you deduct the cost of salaries from gross profit margin. Another fixed cost is rent. So say you have rented the space which you are currently using to bake those cakes. That's fixed cost. There are utilities like your gas, your hydro, water bills. All those are fixed costs. Now, utilities might vary here and there each month, but more or less they are still at the consistent level. And then we reduce all these costs one at a time from the gross profit margin. And then what we get at the bottom is operating profit. Operating profit means a profit without taxes deducted from it. And when you deduct the taxes from it, what you get is a net profit. And this net profit is what you get to keep. You can either keep it in the business itself, or some business owners may take dividends from the business and use it for their own personal purposes. But if you keep it in the business, it's going to help with the equity of your balance sheet. It's going to increase the net worth of your business. So if you were to grow your business, then it's better to keep the net profit, or we'll call it retaining that net profit within the business, which is preferable. So recapping it, revenues have to go up, expenses have to go down, net profit has to go up. If you keep the net profit in the business, that's showcasing or helping with the strength of your business. The banks would love it, lenders would love it. In fact, your business itself, if you were to sell your business, that would be again adding more value to your business as well. So these are the main components of income statement, and the way we looked at it is a vertical analysis. So we started from the top meaning the revenue, which is also called the top line, and then we moved down towards gross profit, and then we further reduced the fixed costs to get to the net profit. Net profit is also called the bottom line of the business. So top line to the bottom line, you want the top line to be higher and bottom line to be higher as well, and expenses are to be controlled. So if your business is making profit, then kudos to you. But if you are not there yet, if it's making losses, then you might have to look at streamlining the costs or look at increasing the revenues. If costs can't be reduced, then you look at how to increase the top line. Try to think of how you can market different products to your customers, like how you can increase your customer base so you have more customers coming in, which means more revenues, and then ultimately flowing down with more net profit or net income. So hopefully this is helpful, and now let's try to understand what a balance sheet is. So balance sheet shows three things. It shows assets. Assets are the things that the company owns or the things that is owed to the company by external parties. It contains liabilities. Liabilities are the things that the company owes to third parties, which they have to pay back. And third is shareholders' equity. Shareholders' equity is the money that either you put into the business when you started it, or you have over a period of time retained into the business. Remember, we talked about the net profit retaining in the business. So that net profit that we retained, it adds to equity each year if you do decide to retain that in the business. Now there is an equation for balance sheet, which is assets is equal to liabilities plus shareholders' equity. And at any given time, this equation holds true. And now what we are going to discuss is some of the assets in a bit more detail and liabilities in bit more detail as well. So let's start with assets. What do they include? In the assets, you would think of cash. Cash is an asset because that's the money that's sitting in your business account. It's your own money, so it's considered as an asset. Next, we look at receivables. Receivables are another type of asset. So this is the money that your customers owe you. So when do you book a receivable? You book a receivable in your book when you provide credit terms for your customer. For example, maybe you give 30-day period to your customer for them to pay you. So let's say today is January 1st. You issue an invoice today to that customer for $30,000. So that $30,000 is going to sit as an accounts receivable because you delivered those services or product for $30,000 on day one, like on January 1st. But your customer has not paid that $30,000 to you on January 1st, but they are going to pay it on January 31st because they get 30 days of grace period to pay it back. So when they pay you on the 31st, then your accounts receivable will be zero, assuming that there were no other accounts receivable. So you started with 30,000 in receivable, but on 31st, your customer paid you, and then your receivables have reduced to zero. Another asset would be inventory. Inventory could be, for example, in your cake baking business, you might be holding some form of raw material, flour or icing. That's an asset because you own it and you are using it to prepare your product, which is cake. So these are some of the assets. Other assets are fixed assets. Fixed asset can include machinery. Maybe you have a blender or any other cake baking machine. Maybe you have something to blend the dough, or you have oven. That's a fixed asset. Maybe you have some office furniture. That's a fixed asset. And then in some businesses, you might also see goodwill as an asset. Goodwill is an intangible asset. You won't touch and feel it. Goodwill is more common in businesses such as where you provide services rather than products. For example, in healthcare services, say for example, dental services, it's all based on the reputation of the dentist, and that's listed as a goodwill on the asset. So this is the asset side of balance sheet, and now we are going to look at liability side of balance sheet. Under liabilities, we can have accounts payable. Think of accounts payable as money that you owe to your supplier. In the same form, like you provide credit terms to your customer, your suppliers may also provide you credit terms. Say again, for the cake making, you purchased flour, but you got 15 days to pay that money back to your supplier. So until you have not paid that money back, you will see that listed as an accounts payable on the balance sheet. Another item on the liability side is overdrafts. Think of it as opposite to cash. So cash is when you have like your own cash, it's sitting as an asset. But if you don't have your own cash, then you are going to lean into an operating line that's authorized for your business. Operating line is like a line of credit that maybe your bank or lender has authorized for you, and then you borrow funds from that line of credit, and that's going to sit as an overdraft on the balance sheet. So that's the money that you owe to the bank. Accounts payable is the amount that you owe to your suppliers. Overdraft is the money that you owe to your lender or to your financial institution. Another thing you can see on the liability side is long-term debt and short-term debt. Short-term debt, you might have a loan, maybe you own the premises where you are currently operating the property or the office, and maybe you took a loan from the bank to finance that building where you are currently providing your services. So that loan is going to sit on the liability side because that's the money you owe. Now the short-term portion is the money that you owe within the next 12 months. So within next 12 months from the balance sheet date. And the long-term portion is the money that you owe after 12 months. Say there is a loan of $1 million out and it's to be paid over a period of 10 years. So every year you are owing $100 to the bank. So you will show $100 as the current portion and remaining $900 as the long-term portion. So this is liability section of the balance sheet. And then the last section that you will see is shareholders' equity. Shareholders' equity, as I mentioned, it's the money that's retained in the business. So it's the net profit that you decided to retain in the business, or it's your original investment in the business that maybe when you started the business, you put 100,000 into the business, then that's your own personal shareholders equity. Plus, if next year or in the first year, maybe you decide to retain 50,000 of net profit into the business, then next year your shareholders equity will be 150,000. And maybe the following year you decide to retain another 30,000 of net profit, then your shareholders equity is going to increase to 180,000, and so on. And maybe in the fourth year you decide to withdraw some money out of the business, and then maybe you withdraw 20,000, so your equity is gonna reduce to 160,000. So that's in a nutshell the balance sheet. I kind of tried to tend to main items that are listed on the balance sheet. There might be some more components that you see, and maybe we address those in a separate video. Now let's talk about the third financial document, that is the cash flow statement. Cash flow statement is divided into three sections. One is cash flow from operating activities, cash flow from financing activities, and cash flow from investing activities. Another thing is cash flow shows the movement of cash in that period. Say you are looking at a 1 year period and you have a cash flow statement, then that's the actual movement of cash. It's not the invoicing, but it's the real cash that was moving. And we'll talk about the cash flow from operating activities. So it's the cash that you actually received from your customers. Like say you sold cakes and of your customers paid for that cake which you sold for 100 per cake. So you actually received 30,000 of cash. So that's a cash flow from operating activity. And out of that 30,000, maybe you paid 20,000 to your suppliers that year. So your net cash flow is 10,000. And then you add net profit or any non-cash items to that to get operating cash flow. I'm keeping it brief, but we can talk more about it in the next video. And when it comes to cash flow from financing activities, that's the money that you either pay to your bank actual cash that you pay. Maybe you paid your loans. Remember our example, we paid 100,000 in loan. 100,000 was the current portion of long term debt. So we paid 100,000 to the bank. So that's money out. So it's going to be listed as a negative or in bracket. Then say we also took another loan, maybe to buy some office equipment for 500,000. So 500,000 is the money coming in, which is actual cash flow in. So it's going to be a positive cash flow. So this is the cash flow from financing activities. And last one is cash flow from investing activities. It's the money that you invest somewhere, or maybe you disposed of some of your investments, some of your assets. For example, you had an old machine that you are no longer using and you disposed it off. So that money is cash coming in, right? Because you sold it and then there was some cash that came into the business that year. Or it could be that you invested money somewhere. Maybe you bought some GICs, or maybe you bought a property, then that's the cash out. So you invested the money and then that's the cash out of the business. And once you add the cash flow from all the three sections, that's the net cash that is available. If it's a negative number, then your business is out of cash. If it's a positive number, then your business is in the cash, which is good. So there you have it, friends. That was a brief about income statement, balance sheet, and cash flow statement. If you have any questions, please feel free to leave them in the comment section below and I'll be sure to answer. If you liked the video, don't forget to hit the like button and subscribe to my channel. That would mean a lot to me. And if you think there's anyone in your network who may benefit from the information I shared, don't forget to share the video with them. I love to hear more from you through the comment section below. And till next time, take care and I'll see you in the next video.